These two things are absolutely certain. Taxes will be going up and dollars will be worth less. So what should you be doing? In this episode, I'm going to address the question, what should I be doing to combat rising taxes and inflation? Get ready. I'm going to empower you to have taxes and inflation not be a concern for the rest of your life if you employ these strategies. So my name's Doug Andrew, and I've been a financial strategist and retirement planning specialist now for north of 48 years. And I've discovered in helping people prepare for a comfortable retirement to hopefully not outlive their money, that there are three big dangers that cause most people to outlive their money on their savings in their IRAs and 401ks and the like. Number one danger is taxes. Because when you save in a traditional IRA or 401k, that's usually just tax deferred unless it's a Roth. And so taxes erode away anywhere from 25 to 33% of what you withdraw out of your IRA or 401k the rest of your life. The next danger is inflation. It's like the hidden tax. And this causes most people to outlive their money because the cost of living doubles about every 7 to 10 years. And they need more and more money because they don't know how to link their returns to the things that inflate. I don't like inflation any more than you probably do, but it doesn't hurt me. It actually helps me because I come along for the ride, and I'll teach you what I mean by that. Third is market volatility, because too many Americans have their money invested in the market when they retire, and they cannot create predictable income streams, and they have to time when they take money out of the market. Otherwise, they lose money during the market downturns and crashes, and you don't want to have to deal with that anxiety during retirement. So I help many people eliminate these dangers. Now, I'm going to go through what I call the tax and inflation power curve. And at the recording of this episode, it's very typical, like the nearly 5 decades that I've been helping people deal with these issues. What causes most people to outlive money, first of all, is taxes. Now, as I'm recording this episode, we have President Joe Biden, who is proposing a ton of tax increases. Now, he's doing that because he has a lot of initiatives that, frankly, a lot of presidents have done where they spend. Basically, the government, when they have all of these stimulus packages and infrastructure bills and everything, when they start adding it up, it will astound you where the federal government many times spends double what they bring in revenue. Well, under Joe Biden, if all of his tax proposals go in and all of his initiatives, what's going to happen is he's going to be spending between 3 to 4 times what the IRS collects in revenue. So let me put this in perspective. If you were making $100,000 a year and you kept spending $300,000 or $400,000 a year, how long could you do that before what? You'd probably have to file bankruptcy. When the government spends far more than they bring in, they have two choices. They either have to print more money, which they've been doing, which causes inflation, and they have to raise taxes. They're doing both because of these initiatives, and we're going to head for a lot of trouble. So, for example, President Biden is changing and increasing income taxes, especially for individuals making over $200,000, couples making over $400,000. He is changing the rules for 401k so that middle income and higher income earners will have to pay higher taxes indirectly because they don't get near the tax deductions or breaks or benefits from contributing to a 401k. He is raising the corporate tax rate from 21% up to 28%. People say, well, that's only 7% more. No, it's 33% more in dollars. If a corporation paid $210,000 on every million of profit under 21%, now they have to pay $280,000, $70,000 more, which is 33% more. Now, sometimes we have politicians who don't understand economics, and they don't realize corporations can't afford just to do that without doing what? Laying off people. So then that causes unemployment, or they have to raise the cost of their goods and services. And so when you have another initiative like raising minimum wages and so forth, it's all for naught because people earn more money, but it's all gobbled up at the gas pump or at the hamburger stand because of inflation, because of the money that's been printed, which causes inflation. It all affects people who are on fixed incomes like retirement. We also have the estate or inheritance tax that's going up from about 46% up to as high as 67% because a lot of tax revenuers, they love to tax people, as I say, that are 6 feet under because they can't complain about it. We have all of these taxes that have to be raised. So what we are facing is a dramatic tax increase and inflation. So let me go through and explain to you what's been happening with inflation, and then I'll show you the results of this. So if you were around in the spring of the year 2021, you would have probably tuned into CNBC or Barron's or Fox Business, maybe Bloomberg, Forbes magazine and Forbes and the New York Times and Market Watch, and they were all in shock because inflation had jumped to 4.2%. And I just sort of went, huh? Now, that's because inflation had been around 3% for a long time. This is smoke and mirrors. Now, if you don't realize this, clear back in the 1970s and 80s, they changed the way they report inflation with the Consumer Price Index. Back during the Carter administration, I've been around. I was around back then. I had my financial planning licenses and so forth. Well, we got to 13% inflation, and the government could not afford to pay Social Security recipients 14% raises, according to the Consumer Price Index. So they said, we're going to change the way we report inflation. Instead of a basket of goods of apples to apples every year, they can change it to apples to oranges, which means the government can choose if they want to compare the price of a filet mignon steak last year to hamburger this year and get away with it. So the true rate of inflation, when they say the Consumer Price Index went up 4.2%, it's usually 2 to 3 times that. Inflation has been double digit. I mean, gasoline at the recording of this video has gone up 50% to 100% in many states. So when inflation went to then 5 and 6% a couple of months later, they're like, oh, inflation's at 6 or 7%. The cost of living will double in 10 years. No, it's going to double in about 5 years. What does all this mean? Now, if this is resonating with you and you can think of somebody that you ought to share this with, be sure and share. Post a comment, click like. But I want you to subscribe to this 3-Dimensional Wealth channel. And when you do, click the little bell because you'll be notified every time I post a financial answer to a question or an educational video, which I do almost on a daily basis. But stay with me to the end of this episode. I want to gift you a copy of my most recent best-selling book called The Laser Fund. It's 300 pages, jam-packed with information you need to know. So when we talk about inflation, I like to use the rule of 72. And if you don't know what that is, it's simple math. See, if you take the number 72 and you take any interest rate you're earning and you divide that interest rate into 72, it will tell you how many years it takes to double your money. That's on a one-time lump sum. So if you were earning 5%, your money doubles every 14.4 years. If you're earning 8%, 8 into 72, your money doubles every 9 years. 9%, it doubles every 8 years. Well, if you were to earn 7.2%, and I like that because that's the lowest rate of return I earned using my favorite vehicle, the Laser Fund, in the worst decade since the Great Depression, 2000 to 2010, when most Americans were still down 38% at the end of 10 years, many people earned 7.23%. A million had doubled to 2 million. So I like to use worst case scenario. So let's say that your money doubles every 10 years and you started out with $125,000. You didn't add any money to it. You're earning 7.2% and it doubles in 10 years to $250,000. That doubles to $500,000. That doubles to $1 million. Does that make sense? Okay, let's say we're here in this 30th year and you have $1 million nest egg. Now let's look at retirement. You're earning 7.2% on $1 million. Well, you theoretically should be able to pull out $72,000 a year without depleting principal, right? Ooh, if it's an IRA or 401k, you got to pay tax. Most Americans, 41 out of 50 states has a state income tax on top of federal. So about 33% is average. That would be $24,000 of the $72,000 you pay in tax. you're only netting $48,000 to buy gas, groceries, prescriptions, golf green fees, and the like. Now that's about $4,000 a month. Sometimes people go, ugh, I thought I was going to get $6,000 a month. I'm only really netting $4,000. I guess we can tighten our belt. Well, that's just taxes. Now, let's look at inflation. If you have $1 million at 5% inflation, the cost of living will double every 14.4 years, about every 15 years. See, because you divide the rate of inflation 5 into 72, and it tells you how fast the cost of living will double. So that means that $4,000 a month in 15 years will only buy what $2,000 a month buys today. And you'll have to have $8,000 a month to buy what $4,000 used to buy 15 years earlier. You're going to have twice the income. This causes a lot of people to then deplete their nest egg. Well, that's at 5% inflation. What have I been talking about? Double digit. So the cost of living, it will quadruple in 30 years. You'll need $16,000 to buy the same gallons of gas and loaves of bread that $4,000 bought 30 years earlier. Well, what about inflation at 7.2%? Cost of living doubles every 10 years. In 20 years, you'll need $16,000 to buy what $4,000 did. Well, the real rate of inflation right now is between 10 and 12%. At 10%, it doubles every 7.2 years, meaning in 15 years, you'll need $16,000 to buy the same gallons of gas and loaves of bread that $4,000 a month buys today. At 12%, it happens every 6 years. This is what we call the tax and inflation power curve. Taxes and inflation, which is a hidden tax, that's what causes most people to outlive their money because they have to take out more and more and more income, doubling the income every 7-10 years. And also taxes keep going up. So that's the danger with the tax and inflation power curve. Now, what I want you to do is protect yourself by converting to tax-free vehicles and learn about indexing so that if inflation goes to 5, you'll earn 10. If inflation goes to 10, you'll earn 15. I've always earned at least 5% greater than the inflation rate at the time because I link my returns that I'm earning to the things that inflate. You would not believe how many financial advisors don't understand how to do that. So if this is intriguing you and you want to learn, and this is what always motivates me to write articles like this, these two things are certain. Taxes will be going up and dollars will be worth less. What should you be doing? Well, you can learn what is far better in this book called The Laser Fund. It's actually 2 books in one. I want to gift you a free copy. To claim your free copy, simply go to laserfund.com, laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll fire out a copy of this 300-page book to you. It's actually 2 books in one. This one is 200 pages, 14 chapters. That has all the charts and graphs and explanations. If you're more of a right brain learner, you learn by stories. You flip it over, you read this one. This is 100 pages, 12 chapters with 62 actual client stories of how the Laser Fund is like this dream solution for retirement and a lot of other financial goals. So claim your free copy. There's options there to listen and learn, watch and learn. There's even an 18-hour masterclass if you want to do a deep dive and learn how to diversify and create the foundation for your tax-free retirement.